Today on the podcast, I sat down with Luke Xie, the founder of SatLayer. SatLayer is an economic layer for Bitcoin and DeFi, which allows holders to earn yield. Users deposit their Bitcoin, and SatLayer routes deposits to best-in-class DeFi yield offerings. Luke and I discussed Bitcoin's rise as a financialized versus idle asset and what lies ahead for Bitcoin. Without further ado, here's my conversation with Luke.
Matt Walsh and Nick Carter are partners at Castle Island Ventures. All views expressed by them or the guests on this podcast are solely their opinions and do not reflect the opinions of Castle Island Ventures. Guests and hosts may maintain positions in the assets discussed in this podcast. You should not treat any opinion expressed by anyone on this podcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their personal opinion. This podcast is for informational purposes only.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden, people start to worry. So out of this worry, we have something called the Bitcoin.
Luke, thanks for joining us today. We're going to talk about Bitcoin, which will be fun. I wanted to kick off to say that one meaningful trend is that you look at DeFi in the crypto industry, the TVL of Bitcoin, referring to the amount of BTC that's being used in DeFi protocols outside of the Bitcoin main chain, is markedly increasing. The last I checked, DeFi Llama cites something along the lines of $6 billion. Babylon has led the pack in that. You guys and a host of other protocols, or a smallish number of other protocols, have followed, but still a meaningful development on that front when it comes to bringing BTC into existing DeFi capital markets. It seems to me that this will continue to progress, but I'd love your perspective on how you see this continuing to move going forward.
Absolutely. I think in many ways, the analogy here is probably like DeFi summer for broader OG/ETH-based DeFi. And I think in many ways, we're still in the first inning, just because I think in many ways for Bitcoin DeFi, a lot of the teams came from the EVM and alt layer one side of the ecosystem and took a lot of the learnings, plus I think just the latest and greatest in terms of innovation, and to build that in various ways on and around Bitcoin. And it goes without saying the strength of Bitcoin this cycle and the biggest factor, I think, driving this bull market. So in many ways, it plays out similarly to if you zoom out and look at the chart for DeFi summer, where I think it ultimately topped out around 300 billion. And that's on a much smaller overall market cap. And that's mostly on Ethereum, which is just at this point a fraction of Bitcoin's value and overall market cap as well. Because I think in many ways, there's a lot of other tailwinds for this with the rise of MicroStrategy and these Bitcoin treasury companies. Now we're getting to the point of, at least in certain markets, near saturation of these treasury companies. And so they're going to have to start differentiating in other ways. And we certainly see on-chain yield as a big differentiator, because at the end of the day, the reason people invest in these companies is to accumulate more Bitcoin. So part of it is how good are you in terms of trade execution on accumulating the Bitcoin that way from the capital you're able to raise in public equity markets. But I think the other portion is, okay, now you have all these Bitcoin that you've accumulated. How do you generate additional yield and growth from that? And part of it is also, especially on the Western institution side, we see a lot of wait and see of wanting for the protocol to be operating for like at least 6 months, if not longer, with no major issues. And then folks will start scaling into this at size. Because I think certainly, as you mentioned, it's around 6 or 7 billion, just depending on like Bitcoin price in terms of Bitcoin that is active in Bitcoin DeFi. And a lot of that is staked into Babylon, restaked into SatLayer. But if you just look at the growth of the wrap Bitcoin assets, the BTC, BCB, BTC, FBTC, and WBTC, those are sitting around 30-ish billion. And I forget the exact number, but I think a year ago, it was 1/3 to half of this. So I think overall, Bitcoin on-chain and being active and productive has definitely grown, I think, exponentially. And I think there's a long way to go from here.
And to your point, those numbers we talked about, whether it's 6 billion TVL, 30 billion across different Bitcoin variants, that's a drop in the bucket when you think about whether it's 300 billion and increasing in DeFi capital or the total market cap of Bitcoin. I'm curious for your view. Do you think the innovation here is to have a lot of the same sorts of use cases you've had since early DeFi, which is on-chain lending markets, trading with Bitcoin as a more center asset? Or do you think it's more novel primitives for Bitcoin and DeFi?
I think it's a mix of both. We're certainly taking this approach along with some of our closest partners, Solve on Lombard, of I think building the infrastructure and the rail, so to speak, for Bitcoin to participate in existing, whether it's ETH DeFi, Sui DeFi, and what say you in terms of EVM and alt layer 1 DeFi? Because I think this was a hot take when I first started talking about it, maybe it might have been like 6 months ago or so. But I feel like now it's almost becoming more consensus is that ETH DeFi was really testnet for Bitcoin DeFi. And I just see a future where Bitcoin becomes the biggest asset in EVM DeFi, in alt layer 1.
How do you look at the relationship between Bitcoin and ETH and DeFi? Are they advantaging each other or at odds? How do you look at it?
I think it partly depends on your time horizon. Certainly this cycle, a lot of folks probably regret keeping their ETH and then deploying that into DeFi. Whereas if you had Bitcoin DeFi, you would just be very comfortable and very happy. Where I think ironically, ETH holders, one of the few asset holders that came out ahead for the FTX bankruptcy because they had locked in 22 prices when ETH was actually at 4K and higher versus for Bitcoin because they locked in 2022 prices, you're like way down. But I think certainly at the same time want to give credit where credit is due in terms of ETH and ETH DeFi builders that really laid the foundation for all of this. But at the end of the day, at least certainly right now, there's only one asset within all of crypto that nation states are accumulating, that institutions are, it's almost become somewhat consensus among institutions to accumulate, which is Bitcoin. Not ETH, not Solana, certainly not the long tail of crypto.
Yep, makes sense.
And then I think the other piece to add is I do think there's going to be some innovation in terms of how Bitcoin is used in these DeFi/financial use cases. And that's in part because from what we've seen and the conversations we've had with our users, Bitcoin holders are a bit different than ETH or Solana holders in that they're okay with much lower yield as long as there's much less principal risk. And so that's one of the reasons that I think one of the big use cases that we've been spending a lot of resources and time developing with some of the partners in this space, like Nexus Mutual and a few others that we'll announce soon, is insurance that's backed by Bitcoin and also for Bitcoin LPs. So we can get into details later, but the idea here is really almost like structuring a product so that you have principal protected Bitcoin yield. And this again comes from our conversations with some of the largest Bitcoin holders and miners in the space, where generally they are okay with low single digit yield as long as there is principal protection.
It's very interesting to me. I like the point on yield because if you look at the US dollar and you try and peg something of a risk-free rate, you're probably in the 4 to 5% range. And every crypto asset, your yield expectation of a base yield would be higher. I think would be probably something in the 7% plus range. For Bitcoin, to my understanding, it seems lower. Most people who own Bitcoin are looking for Bitcoin yield. I'd say their risk-free rate is lower than that of 4 or 5% potentially, which I think speaks to how unique the asset is and the potential affiliation with something like gold.
Totally, because I think relative to most other crypto assets, and then I think arguably even the dollar, Bitcoin is lower risk and a better store of value. Without, again, going into this rabbit hole, but I think we are seeing continued inflation of the dollar and this continued kicking down the road of the US debt issue, which is, I think, also made a lot of other central banks around the world and other countries start rethinking how much US debt they hold and their alignment and reliance on the dollar. And I think a lot of our team have viewed that Bitcoin is on the path to becoming a global reserve asset. Now, we're not saying it's going to be the global reserve asset, but we are saying it is going to be a global reserve asset, just given, as I mentioned, the US debt issues and just overall global macro and geopolitics are going. So overall, what we're trying to do at SatLayer is really to help usher in that future, and then also to effectively be the economic layer to unlock initially a more financial focused use cases for Bitcoin. And both plugging into existing DeFi and then on the yield and liquidity side, as well as on the security side with some of the use cases we're working with partners like Plume and Layer Zero.
We had the same thought. I was going to say that was a good segue to talk about SatLayer. To put a bit more of a fine point on it, maybe, you guys are aggregating Bitcoin capital and you're finding yield opportunities for it in the market. I'd love for you to speak to how you do that and where you see yield being generated by Bitcoin, because early on, I think there's a lot of demand for people, for example, to borrow US dollars against their Bitcoin. But I'd love to hear your views on, will there be appetite to borrow Bitcoin? What will be the yield generation sources for Bitcoin?
I think for us, we certainly sit at a bit of a unique position in the entire ecosystem where from a user flow wise, we are downstream from whether it's your wrap Bitcoin or your Bitcoin liquid stake token. And then we are intentionally not a chain. So we're able to actually deploy our contracts on a lot of the strongest L1s and potentially L2s as well in the ecosystem, like Sui, like Berachain, like BNB. So in terms of like where we sit, we basically enable users to almost create this at least 3-4 stack of yield. So you get your yield from your Bitcoin LST, for example, that stakes similar to Lido does. These Bitcoin LSTs like Solver Lombard will stake your Bitcoin into Babylon for you, but giving you a liquid stake token that then you can then deposit into SatLayer. And then right now, there's a lot of L1s that are incentivizing Bitcoin on their chain to also drive, I think, their DeFi ecosystem, like Sui, like Berachain, and a lot of the up and coming ones as well. So that's your third set of yield. And then we have our own Sat Squared rewards program. That's the fourth set of yield. And then we intentionally also mint the receipt token. So for the more DeFi natives or DeFi degens, you can then take it onto lending, borrowing, or DEX LP if you want. But that's totally optional for the user since there sometimes is risk associated with that. And then I think in addition, for us, it's really on the user side and very much the beginning, where a lot of the big use cases that we're focused on, some of which I touched on earlier, are insurance backed by Bitcoin, as well as stablecoins backed or secured by Bitcoin. So Cap Labs is one of our partners who's integrating with us, as well as Eigenlayer and Symbiotic in a very restaking native way, where in their architecture, the operators are actually the ones that are generating yield for the stablecoin. So it's a lot of the market makers in the space, as well as TradFi players like the IMC Tradings of the world. And then we're also working closely with Plume on their Nest Credit side of things. We're providing liquidity float, as well as on the core RWA business, where for their RWA transfer layer called Skylink, that we will be providing Bitcoin security for that. Just given effectively the overly simplistic version to think about it is it like an RWA focused bridge that's built as a layer 0 DVN. And that's where we'll provide Bitcoin based security. Just given that in general for bridging, that is the most important thing is how secure your bridge is.
Especially for Bitcoin.
For RWAs as well, because I think it's a lot of times there's assets tied to token representations of real world assets that also, again, like security is very important versus like a gaming asset, for example, where maybe more cost is much more important than speed. And then I think the final use case is really around almost liquidity float, repo, or prime brokerage that's on chain and backed by Bitcoin. So here, we actually just announced this yesterday. We're working with Aether in terms of on the AI infrastructure side to help some of these AI infrastructure providers access a lot more and deeper liquidity that's Bitcoin backed. As right now, we're seeing the boom in AI infrastructure.
I love that LSTs, or for anyone listening, crypto tokens that naturally give you the yield of the underlying chain as if you staked your Ethereum. I love that that's a canonical part of crypto now. And I think that you guys said an interesting point, because essentially you're saying, okay, now we need to rebuild market access in the way that capital flows for these LST tokens, especially in the case of Bitcoin, where it's completely novel. And I remember when EtherFi did a similar thing in the Ethereum context. And in my opinion, it makes for better markets if the default asset becomes the one where you're automatically getting that risk-free rate, as opposed to just the standard Bitcoin or ETH.
100%. Yeah, I think EtherFi is a great example where they're almost becoming a bit of a neobank and then just giving users easy access to yield. In their case, primarily focused around ETH, but also being able to, with their credit card product, like spend it. Because I think in many ways, people by human nature are greedy. And when you have such a great asset like Bitcoin, of course, you would love to have yield on Bitcoin, get more of it. So that's where I think it's also the benchmark rate for Bitcoin is going up. Historically, especially before I think the emergence of Bitcoin DeFi, was really around sub 1%, 0.5% range with these delta neutral strategies. But I think as anyone in crypto knows, especially folks that have played with options, delta neutral. It's kind of in some ways like picking up pennies in front of a steamroller. It's great until you're unable to roll your option, then you're stuck getting exercise, and now you're down 10% on principal instead of up a couple percent on yield. Whereas currently, to be fair, on-chain yield, it's not zero risk either, but I think there's contract risk or front-end attacks, et cetera. But I think in general, a lot of the teams definitely have security top of mind, including ours, and have gotten multiple audits from a lot of the leading firms, plus just internal good practices and internal audits to just minimize that risk. But that is another reason why we put a lot of resources on developing these insurance/cover products that's backed by Bitcoin for Bitcoin. It's just giving users, I think, another layer of assurance and security on their Bitcoin assets.
I wanted to ask your perspective. We have dollars in DeFi, which makes for a perfect comp in that there's a borrow rate on Aave and there's a borrow rate with JP Morgan. And you can compare the two and you can go decide to do business at either one. With Bitcoin today, obviously, yield and markets around Bitcoin and traditional finance are very nascent. It's very much a treasury asset right now, to your point. And we have evolving ways of earning yield on your Bitcoin in DeFi. Eventually, my hope would be that Bitcoin is just used more often in finance. And with that, you'll be able to lend and borrow Bitcoin more effectively because people will accept it when it comes to wanting to pay for things. It'll just be a holding asset. You can spend with it more effectively. Does that become competitive with DeFi yield, in your opinion, for Bitcoin? And is that a nexus of competition if traditional firms start to not just hold Bitcoin, but start to do financial operations and enter financial markets with the asset?
I don't think so, because I think in many ways what we're seeing, maybe stablecoins is probably the best example and the most top of mind for folks, is that now you're seeing whether it's Web2 fintechs or even the traditional banks embracing stablecoin or launching their own stablecoins. Because overall, the way I think about it is just fundamentally crypto, whether it's stablecoins or Bitcoin or ETH or whatever, is just a better form from like a product perspective of money.
It's a better form of money. I get what you mean.
Especially stablecoins is straight up a better form of money in like almost every dimension versus paper fiat money. You don't have the printing costs, and then there's a maintenance cost to having paper currency, which is not insignificant for like a lot of major countries. It's in the I think tens or hundreds of millions a year. You have the fraud of I can just print money that looks almost as good as the actual thing, and a lot of places can't tell. And then you have V1 digital money of the Venmos, PayPals, WeChat, and Alipays. But those are centralized. And certainly for a good number of folks in crypto that have been suspended or debanked from some of these platforms, there's centralization challenges and risk. And if you get blocked, it's horrible because there's sometimes no recourse or it takes like months to unlock your account. And meanwhile, you have funds stuck there. Whereas I think for stablecoins, by nature, you can't really have counterfeit fraud because you can see very clearly that this is the USDC or the USDT. This is the contract. There's billions or even trillions of assets in this contract. And so this is obviously the real one and not the fake one. And then you can't counterfeit and print more of it. You also don't have the centralization risk of, oh yeah, I got blocked by Venmo or PayPal. And then it's also by nature, all the transactions are on chain. And then you can't have the, oh, I sent an international wire, but then somewhere along the way I got stuck and nobody knows where it is. You can see exactly where it is. You know right away if it's sent out or not. So I think by nature, it's just a better product. And I think for TradFi, they've come to understand it now. And especially just given how long a lot of these things have been around, it is battle tested. And so now they're ready to launch their own version of it or collaborate and enter at scale. And so I think on the Bitcoin side of things, I would expect you would see something similar, but I think there's a bit more of an edge on the more crypto native side because there is no TradFi direct analogy for Bitcoin, and people aren't going to build gold DeFi. So I think on the Bitcoin side, the innovation comes more from the Bitcoin native and crypto native side, and then it's the traditional players just onboarding.
The thing I think is beautiful about Bitcoin, to your point, is it's one asset, whereas with cash, we have physical cash, we have digital money in a bank, we have stable coins, and we call them the same thing, and functionally they are in our economy. But those are three different iterations of an asset that you're calling a dollar, whereas with Bitcoin, you really only have the Bitcoin on the ledger that is traceable, you know exactly where it is. There is no Bitcoin form of cash. Things like that have been tried, but it's not the default asset. And I think with that in mind, it validates what's happening in DeFi if people in traditional finance are using that same asset. Whereas with something like cash or stable coins, you still have hard cash and you have digital money and you have stable coins. So it's a slightly different iteration, which creates friction. And my hope is that that'll be a strengthening factor for Bitcoin across all markets eventually.
100%. And also, Bitcoin is just such a unique asset where it's fixed supply. Countries can't print it at will. And I think it's become globally recognized. So not only are you having the really small, from a relative size perspective, countries like Bhutan or like El Salvador adopting Bitcoin, but you're seeing some of the Middle East players like Mubadala accumulate Bitcoin and then be very public about the fact that they accumulated Bitcoin. And US, of course, adopting a strategic Bitcoin reserve. But I think it's been fascinating on the US side to see, as of now, I think at least 3 states that have front-ran the US government in passing laws to adopt and set up their own strategic Bitcoin reserve, as well as I think many countries in the world that are more discreetly accumulating Bitcoin, minimum as a hedge. Because I think the narrative is very much shifted on central banks of, well, what if the US actually accumulates Bitcoin in size? Then it's too late for us. So we should probably get a little bit just in case. And then I think even in traditional finance circles of Ray Dalio, where it's like FinTech Frank put it really well on Twitter of, he traced the journey of Ray Dalio. First, he was like, Bitcoin is garbage, is a scam. And then Bridgewater starts buying some Bitcoin and play around with it. And now he's recommending everyone allocate 15% of their portfolio to Bitcoin. So in many ways, going through the typical journey we've all had in crypto.
I was listening to a podcast he was on recently with Chris Williamson, who does Modern Wisdom, and he was talking about his view on global power politics and 5 powers. And I was like, how does this guy not believe in Bitcoin? Or how could he if not? And he must be on one side of the fence because it definitely fits into his overall narrative one way or another.
Yeah, 100%.
I did want to ask you, as we look at Bitcoin broadly, I think a lot of Bitcoin holders come at it from an original angle of either something of a libertarian streak and maybe extend that to even a diet form of libertarianism that's in a lot of people, or alternatively, crypto investing curious and they wouldn't buy other crypto assets, they wouldn't buy other stocks, but they'll buy a little bit of Bitcoin. I imagine there might be a lower risk tolerance of folks like that when it comes to even working with an application that wants to go and earn the yield on their Bitcoin, because of maybe an initial skepticism of financial markets and institutions generally, or maybe a preference for simplistic investing. The point I mentioned, it's someone who might not invest in other crypto assets or stocks. Do you find that to be something that is a friction when it comes to encouraging people to earn yield on their Bitcoin? Is that evolving? How do you look at it?
I think it's evolved a lot. And I think in many ways in Asia, folks look at it a bit differently. Part of it is when the Asian institutions and the Asian world and OGs in many ways are a lot more pragmatic and less idealistic about Bitcoin, crypto, really anything. Because in some ways, the big difference maybe between Asia and the West is religion in many countries is not really necessarily the majority, and people take a lot more of the practical view to things. And so certainly what we've seen even a year ago is that the biggest miners, institutions, OGs in Asia have been actively deploying a portion of their Bitcoin holdings into Bitcoin DeFi. And in many ways, they're really just almost embracing portfolio theory. And for them, it's their on-chain DeFi allocation that they're deploying into Bitcoin DeFi. Whereas in some ways, ironically, what we've seen with a lot of Western institutions is they'll just take a wait and see approach and not even play around and experiment, wait like 6 months and 12 months, and then start sizing in. Having said that, I think it has been over a year since we started on this journey, and then even longer for projects like Babylon that we work very closely with. So I think now you are seeing some of the Western institutions coming in, and it also, in many ways, I think a lot of the Asian institutions really paved the way and showed them, hey, I've been deploying my Bitcoin on chain for a year plus 18 months and really haven't had issues.
I like the behavioral point. From my experience, at least, I still have family back in Iran because that's where my dad grew up. And that's an extreme, but the economic stability there is relatively low. So there's not what I would call an economic centering, which we have in the US. You don't really have a proxy. So therefore, people are more exploratory and open to new ideas. Whereas in the US, you're always saying, oh, I have treasury bills, I have the US dollar, I have my local bank. And there's a comfort in that discourages going elsewhere. And I don't know if that's an impact on the Eastern culture, Asian culture, like you said as well. But I imagine, especially outside of China, it probably is to some degree, just because the US is the very obvious. We feel incredibly centered in our economic system because it's the predominant one.
Yeah, I think it's very much the case. And it's a mix of, I think, distrust in government, in centralized institutions, or less mature financial products. China is a great example where credit cards are not a big thing in China. Credit card is the standard in the US. If you don't have credit, like, what are you even doing? And a credit score. Whereas in China, in many ways, it was almost like one of the leapfrogs is they just skipped credit cards. They went straight to WeChat Pay and Alipay. And now you can get some credit products from WeChat and Alipay. Mentally, it's much more of a less, I think, debt-focused culture where folks are just used to like saving up and then paying primarily cash for a home or paying cash for a car, not really financing. And that's not even the extreme. As you mentioned, like Iran or like Turkey is a great example where Turkey is a massive Bitcoin market and crypto market because of their own currency stability. Same story like El Salvador. And then you have, for example, in Korea and Japan, where especially oftentimes the outgoing president or the outgoing ruling party officials just get thrown in jail right afterwards. There is no trust in centralized institutions. And I think that's why these markets are some of the biggest in crypto, is that for them, it's like, well, either use the existing infrastructure, which is really just not transparent, in some ways stacked against me, or I use these crypto products where it's at least everything on chain, traceable if I do want to.
It is shocking. The US is behind when it comes to instant payments compared to things like Pix and M-Pesa that you have in countries around the world that you would argue we should be at least on parity with from an instant payments perspective.
100%. And like FedNow, who knows when it'll finally launch.
Yeah, agreed. Very interesting stuff. I'd love to hear maybe in closing, what should people be excited about in the near term when it comes to how Bitcoin financial markets will evolve? What will we see?
On the near term, one of the most interesting areas, as is the case with stablecoins, is I think the convergence of crypto native products and offerings, and then almost like TradFi and fintech offerings. I think, again, you're seeing this probably initially outside of the US. You have some of the biggest players in like Latin America, as well as Europe, and then I think certainly Asia as well, launching some of these products. And at the same time, I think you have innovative players in the US, like Meanwhile, which is doing life insurance. It's actually backed by Bitcoin. So very much, I think, on the same wavelength as our thesis here. And I think it'll be super interesting, especially with, I think, the much more friendly regulations and also regulatory clarity that you now have in the US. That's, I think, now going to pave the road for the rest of the world. Because I think in many ways, a lot of regulators around the world still look to the US SEC and CFTC when setting their own regulations. So I think it's going to be really interesting to see the Cambrian explosion of innovation that I think we've all been building the foundation for and like waiting for the floodgates to open. I think the other super interesting piece is on the stablecoin front. I'm particularly interested in the response of the other global currencies now that the US is pushing USD-based stablecoins and really embracing stablecoins. Because I think for the other major currencies, if you do nothing, then USD dominance grows and it eats your currency's lunch. So you're seeing this certainly like in Korea, which we've been following closely. Korean regulators have also embraced stablecoins, and a lot of the major Korean conglomerates are launching stablecoin initiatives. Because I think in some ways it's almost a topic of national security for them in terms of like ensuring the future of the Korean won. Because stablecoins by nature, they are fractional. So it's almost like for any currency that's effectively pegged to the US, if there's global adoption of stablecoins, why do you still need your currency? Do the math and just use a USD-based stablecoin instead.
Yeah, couldn't agree more. We'll have to circle back in a year or two and see how things have landed.
Yeah, I think it'll be fun to look at what played out and what didn't.
Thanks again, Luke. Really enjoyed it.
Awesome. Thanks for having me. It was a lot of fun.
Thanks for listening to another episode of On the Brink with Castle Island. To find out more about Castle Island, visit castleisland.vc. To listen to all of our podcast episodes, please go to onthebrink-podcast.com or just click on the tab in our website. Thanks for listening.